This week on the podcast, Sean, let's do some reaction videos since that's all the rage on YouTube and has been for a while. I'll give you some financial hot takes, and then you give me your take on what these notable financial talking heads had to say. How's that sound?
Well, we'll see. We'll see if their listeners get upset or they're happy with what I say.
Okay, fair enough. All right, well, we're going to start with a pretty simple one here. Robert Kiyosaki, many people might know that name, author of Rich Dad, Poor Dad. Really good book, came out a number of years ago, helped a lot of people, actually. Seemed to be pretty good. He's moved in a much different direction in the later years since that book. And here's one of his interesting takes more recently. He said people shouldn't work for a company and invest in the retirement plans. Instead, they should launch their own startup and buy gold, silver, and Bitcoin. A little aggressive.
I mean, I think a lot of this stuff that gets said is said to gain traction or get people to click or listen or view or whatever it may be. But the beauty about living in the United States is that any individual, any person, whether you're an adult or a child or whatever it may be, you have the right and you have the opportunity to build your own business. Which is phenomenal. There's a lot of very successful business owners in our country. With that being said, not everybody internally is cut out to build a business. And so let's take, for example, the person who's working 9 to 5 and they're crushing it at their job. They're saving into their 401k and they read this and they're like, "Oh, Robert Kiyosaki said to do it, so I'm going to quit."
Right.
And
I'm not gonna put money in my 401k. Yeah.
Yeah. I'm gonna quit working. I'm gonna build my own business. Well, there's a simple reality in our country that doesn't go away if you quit your job. You most likely still have bills to pay. And if you just quit and you're like, I'm going to create this business, unless that business is profitable right away, or you have revenue or money that you've saved on the back end, it takes a little bit of time to create revenue and to create an income stream in a business. It doesn't mean that it can't be done. It's just the reality of it is it just takes a little bit of time, and not every person can do that. One, financially, or two, mentally. A lot of people just like the comfort of being able to go to work, get a paycheck, save, go to work, get a paycheck, save, and then retire. There's nothing wrong with that. Now, gold, silver, Bitcoin, like, cool. Like those are options to invest in.
And maybe have a little, Sean, because I mean, they didn't have a very good couple of weeks ago. Like, I mean, gold and silver took they were climbing, then they took like a 30% crunch,
Since October 25th, Bitcoin's cut in half.
Yeah, there you go.
So the stock market is not cut in half since October 25th. It's up double digits. So yeah, I get it. Like I get that Bitcoin's cool, and I think that gold and silver have been around forever for as long as. But
fractional, right? Fractional.
Yeah, it's usually. I mean, if you look at other advisors or big well-known money managers, they say 5 to 10% in commodities, and so should you sell everything and go run for the hills of gold and silver? I don't think so. Should you put everything into Bitcoin? I don't think so. Should I put everything into Microsoft? Probably not.
Right.
It just doesn't make prudent sense to give a blanket recommendation and say, quit your job, build your business, invest in gold and silver and Bitcoin only. That doesn't make any sense to me.
Yeah. And to your point, like all these notable talking heads here, it's a little different than being in the trenches and serving people and being governed the way you guys are, and the way a lot of advisors actually are. These people they're not covered by the SEC. They can say whatever they want. They're trying to sell books and airtime and clicks and all that stuff. So we have to kind of keep that stuff in mind.
It's easy to do and say what you want when you're not licensed.
Right. Yeah. So with that thought, okay, so the next one, right? So if that was a little aggressive, Suze Orman, host of Women and Money, big name in the space, she said recently she suggested 3 to 5 years, Sean, of money set aside in case the market downturn or something like that. So taking the emergency fund to an extreme level.
I mean, that's aggressive.
Aggressively conservative.
Yeah, like that's an aggressive amount to have in a savings account.
Hard for a lot of people to do 5 years worth of living expenses. I mean, that's crazy.
Well, let's just say that your expenses are $60,000 a year. You want people to have 300 grand in a savings account,
doing nothing for you.
Earning, if it's at like your local credit union or bank, it's earning less than a point or a percent. If it's at like a Fidelity, or you may get a little bit higher, 3 to 3.5 to 4%. But getting to 5 years of safety net saving, it tends to be hard, because you have to in a lot of cases, you have to choose where you save. And do I either save in my retirement accounts, or do I save in after-tax accounts to get to this arbitrary goal that she put out? And I guess my question or rebuttal to this would be, why? Why does a person need 3 to 5 years of savings in a savings account in order to accomplish said goal?
In case the market downturns, right? So. I mean, it's easier to do if you've also got a ton of money like some of these folks do, right? To set aside this much stuff. I think for the average everyday person, I mean, 3 to 5 years sounds crazy. I mean, most advisors say, 6 months worth of stuff, right?
Yeah, 3 to 6 months for an emergency fund. Now, maybe I'm going to play devil's advocate here. Maybe she's saying, you know what, have 5 years in like an after-tax brokerage account or something that you can access it. But if you're, once again, goes back to the working person, you can save what you can save, and you have to make a choice of where you save that money. Yeah. And well, now we've heard, put everything in Bitcoin, put everything in gold, put everything in a savings account to get 5 years. Right. There's a lot of competing philosophies out there.
Well, hold on to your hat, because we got more. So the next one here is from Kevin O'Leary, Mr. Shark, and his
Mr.
fantastic
Wonderful.
suits. Mr. Wonderful, that's right. Shark Tank in his crazy suits that he has. He's got some interesting suits. This might actually be the most reasonable hot take of this whole list, Sean, and this one's still a little too much, I think. But anyway, he insists that if you don't know your net worth at all times, you are being irresponsible with money. He promotes constant tracking, optimization, and performance measurement. Now, I think on the surface, this is a good idea. The constant might be a bit much for most people.
If you ask me if I knew what my net worth was on a weekly basis and what my account balances were and everything, I could tell you yes, because I've got a full-fledged built financial plan for myself and my family. I know how much money gets transferred in. I check our one system on a weekly basis. I get a weekly email that gives me an update. But I'm also in my accounts quite a bit just because of the systems that I'm in.
Sure, and you're in this industry, right? So that makes sense. And I think we should have an understanding of what we have, to Kevin's point here. I just don't know about the constantly for most people. That's why we hire somebody to help manage this. I
mean, we have a lot of families that don't know day to day where they're at, from a net worth perspective, but they know. And that means that they know they track it maybe on a monthly basis or a quarterly basis. We track everything for them, but they also track, maybe on their end as well. I like this philosophy to a point, but I think constantly knowing what your net worth is just going to roam around in your brain, and you're either going to feel successful or you're not going to feel successful. Yeah. And you're going to constantly compare yourself to other people based on what they say. And it just clouds the mind for things that are probably more important for a lot of people than knowing what their net worth is minute by minute, hour by hour. But I actually like Mr. Wonderful. I think he's done a great job, like the way he builds businesses. But I would guess that he doesn't know his net worth as we sit right.
I don't know. He says he does, so maybe he does. So Kevin, if you check this out, let us know. All right, so I saved the two most interesting for last, and there were no list of controversial financial hot takes, Sean, would be complete without old Dave. Dave's built himself quite an empire. helps a lot of people, has a lot of good things that actually work. I know a lot of advisors they like a lot of his debt conversation stuff, not so much maybe the investing stuff. But anyway, here's the controversial take. You tell me what you think. He's tackling the rule of thumb of 4% here. And he's advocating for 8%, Sean, annual withdrawals for people for retirees, who invest 100% in the stock market. Because if over time the S&P 500 yields 10%, then he says you shouldn't run out of money. 8% at 100% of your portfolio in the market, I think would scare most people into a heart attack.
So 8% of what? So if you're 100% in the market, and let's say
you get $1 million, make it easy.
So, but if the market corrects like it did, let's go back to 2007 and it was 07 to 09. And the S&P 500 was down 53%. So are you still taking the 8% out on the original amount? Or do you cut your income down to 8? Is it just 8% on whatever the balance is? Or is it like my starting point's $1 million, I'm going to pull out $80,000 a year?
I'm guessing based on the fact that he says that, typically the stock market does 10% year over year, right? On average. Therefore, you could pull the 8 and be fine. But yeah, to your point, now somebody watching might say, hey, the last 5 years, it was all like 20 plus. So, Dave's on to something here. To your point, there's 2 or 3 years there where there was a massive one. What about the 10 years where there was nothing? All right.
Well, I can tell you right now, from 2000 to 2009, you would have run out of money.
Yeah.
That's just the reality of it. We've got all the data and all the studies that show, if you go even at a 6% withdrawal rate, your asset base is cut in half or cut down by 65%. Yeah. So if you're telling me that if I've got $1 million, I can create, just by using the S&P 500, I can create $80,000 a year. I would argue, I say, show me the data that it works long term.
And that's the trick, right? It is the long term. And what are you doing on the years that it is down? And then even so the math fundamentally does make sense based on what he's saying, right? If you just kind of, lay it out there. But that's where the sleep at night stuff starts to come into play. How many retirees, and again, retirees was the topic here, feel comfortable with 100% of their money in the stock market as they're getting close to retirement or into retirement? Probably not very many.
Well, average return is very different than real return. And if I'm up 20 1 year and down 20, my average is 0. However, my real return is less than, because if I go from $1 million and get a 20% return, I'm now at $1.2 million. If I take a 20% loss that next year, it's not 200 grand down, it's 240 grand down, because it's 20% on the $1.2 million. So now I'm at 960.
Yeah, so great point.
Average and real are two different things. So, and then you couple that an 8% withdrawal on top of that. So now I go from $1 million to $1.2 million minus 80,000 my first year. So I'm at $1.1 million minus 20%, which now drops it down to closer to 900. Now I'm, another 80,000 down. So now I'm at 820. Oh crap. Now I'm just cannibalizing my portfolio, and it's really only going to take a down year or 2, maybe 3 to really hammer that portfolio if you're taking withdrawals. So I would challenge Dave Ramsey to actually show me the math that works, and then I'll shut my mouth.
Well, you guys just saw him in an event not long ago. I think if you went to that one, and I
didn't go, but yeah, I mean, I love his debt stuff. I mean, he's created a great business, but that math doesn't math to me.
Yeah. Okay. All right. Well, then I saved the wild one for last. This is a little bit more out there, I think, than most people can stomach. The world's richest man is where we turn to for this next one, Mr. Musk. He predicts that advances in AI, energy, and robotics will generate such an abundance of resources for all individuals that retirement savings in the future will become irrelevant. On a recent podcast, he said, don't worry about putting money away for retirement in 15 or 20 years, 10, 15, 20 years, it won't matter because there'll be these resources from every place else. And the thing is, Sean, is I think he actually does believe this, and maybe he winds up being right. However, in the course of human history, my devil's advocate says, who do you trust to divvy out these resources to everyone, right? No person, no company, no government would anyone trust to say, yeah, I'm going to trust you completely to give me everything I need in the future for retirement. Now, they might, but it might not be the retirement or the lifestyle that you want to live.
The last time this happened was in 1776. And don't worry, we'll take care of you, but we're going to tax you a little bit. You'll get everything you need. Just go to that foreign country and we'll make sure that you're part of our
thinking
plan.
About that's hilarious because we get taxed on so much stuff now, and yet we had a problem with a tea tax, a long time ago and started a whole country over it. But
could you imagine if I'm just playing devil's advocate here, if our government's like, yes,
this is just for
we're gonna take care of you, and it's not what our people want.
Oh yeah, right? Well, and for the guy who's going to be like in like the first trillionaire ever, here, like I think before the year ends, possibly. And if he's wrong in 20 years, he's living on Mars anyway. So what does he care?
If you truly believe that, Musk, divvy out your $1 trillion to the American people that need it the most, and see how long that money lasts. Because here's the issue. Like, you look at the lottery, for example. Like, I don't know the numbers, but a bulk amount of people that win the lottery are broke in 5 years.
Yeah.
So are we just like talking about taking care of society into perpetuity?
Right.
Or
what is that? They were talking about some automatic living expense. They were going to dish out something. Everybody gets like a monthly kind of stipend for living expenses, and it's like, come on, that's in the history of humans that is never played out well. And at some point, somebody's taken way more than they should, and other people aren't getting it. It's a bad idea, And I do think he totally believes that the advancements will probably get some things there, and maybe they will, but I don't trust anybody to.
I believe that it's probably going to make a lot of people rich, and that's a
right.
Okay thing in this country. That's how our country is built. But as far as just saying, hey, everybody's just going to have the money that they want.
Yeah,
I don't know that I agree with that, but I do think there's going to be a lot of opportunity in this country for our citizens to create wealth, and that's an okay thing. That's fine.
That's great. But don't worry about putting money away for retirement. In 20 years, it won't matter. And you take that advice, and in 20 years, you're like, well, that didn't play out so good.
I'm completely reliant on Lord Musk now to take care of me.
Right. Or someone, right?
Yeah.
Or AI overlords or the, Cyberdyne systems to take care of us. So yeah, no, it's again, fun conversation, financial hot takes. It's easy to say this stuff when you have no real skin in the game. I mean, people might say, well, these people are in the financial space. They do have skin in the game, but not really, right? Because they're just offering up ideas and hoping that you'll buy their book or listen to their podcast. I know that we're on a podcast and doing that, but the difference is that you actually see clients, you guys see clients, and you actually are governed. You build plans and strategies based on the things they have, not kind of the fountain of wishful thinking.
Right.
Fair enough?
Hey, it creates some good entertainment.
Yeah, for sure. And hey Elon, if you're right, I take back everything I said.
Yeah,
and I'll come hang out with you on Mars.
Bro. I'm happy.
All right, well, that's going to do it this week for us here on the podcast. Thanks for hanging out. I'm having a little bit of fun with Sean and I. Don't forget to subscribe to us on Apple, Spotify, and of course YouTube. Hit that thumbs up and notification bell for future episodes. And if you do need help, go and click on the links below. Get some time on Sean's calendar. Have a conversation with he and his team, and get an actual strategy in place for the rules and the things that we do have right now, so that you can be setting yourself up hopefully for a responsible and a fiscally sound retirement future. And the team can help you. Again, click on the links below to get yourself some time on the calendar. Sean, see you next time, buddy.
Hey, thanks, man. Appreciate it.
Have a great week, everybody. We'll catch you later here on the podcast.
This podcast has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this podcast is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Walter Storholt, Mark Killian, and Third Wheel Media LLC are not clients of Elevated Capital Advisors. They receive cash compensation for their assistance in preparing and hosting this podcast, and for providing the endorsement contained in this podcast. Because Walter, Mark, and Third Wheel Media are compensated in connection with this podcast, they have a material conflict of interest in providing their endorsement.